Welcome. This is Christian D. Evans with Journey with Christian D. Evans podcast. Thank you so much for tuning in. Ladies and gentlemen, we have an incredible guest today. Just very exciting. He's all the way in Hawaii, and we're here all the way over in the Eastern Coast. And so we're just excited to be able to network with him, talk to him. We've took quite a while just to be able to work with him, jumping him, his knowledge, his expertise, and bringing him on. I just want to share with you real quick. He's been an ex-civil engineer who invests passively in real estate from Honolulu, Hawaii. He used to be in a big bad private company as a construction engineer, but after some saving and investing, he found happiness and balance at a lower paying job. His journal, his experience, and simple passive cash flow podcast, which you can actually find that link right below here as well. And he put it on iTunes, Google Play, all sorts of different places. And his parents got screwed with his 401k and stock market. And it's his mission now to get everyone on the corrupt, get them out of the corrupt Wall Street roller coaster and into Main Street, invest with safer, high returns that benefit the middle class of America with his real estate empire. So very excited to be working with you, Lane. Welcome. How you doing, man?
Hey, thanks for having me, Christian. Aloha, everybody.
Good. Awesome. Well, hey, man. Well, I just want to dive into a little bit. I know that was just a preliminary. You've been able to build an incredible real estate empire, and obviously where simple passive cash flow is going right now. So go ahead, just tell our audience a little bit about you and kind of what that future looks like for you, man.
Yeah, so today I think I own like around 6,000 plus rental units. We put together large apartment syndications for people to come alongside us and partake. But it didn't always start out like that, right? Like I bought my first rental in 2009 when I was still working my day job. Up to that point, always taught to go to school, study hard, be a good little kid, and follow that what I call the linear path that a lot of high paid professionals go down. I started to realize that, like buying your house to live in, investing in retirement funds, which mutual funds, 401k, just didn't work once I started to invest in real estate and got that taste of cash flow.
Mm-hmm. Definitely. And so let me ask you, because obviously, to be able to acquire 6,000 units and be able to do what you're doing now, obviously it comes, like you said, with some ups and downs. Now there's tons of different strategies in the real estate market. So what was your niche? What was the thing that you focused on? Was it wholesaling? Was it flips? Was it focusing on buy and holds? Or I'm curious, what was that strategy for you, Lane?
Yeah. I mean, I think when most people think of real estate investing, they think of like the HGTV, house flippers, wholesaling properties. It's been buy and hold passive real estate from the beginning. Just boring, buying properties that cash flow. And this was because I had my full-time day job. And, this is the kind of the people I work with, people who make a professional salary, or they already have a bunch of money already. And now they just need to put it into something that grows for them. And, the big thing is about taxes too, right? It's not really about what you make. It's what you keep at the end of the day. So, like the biggest thing for us is like investing in the right areas and investing in the right properties so that we cash flow and hit this around 1% rent to value ratio threshold. So you take the monthly rent divided by the purchase price, it needs to be 1% for us to safely cash flow on a month-to-month basis.
Definitely. So let's dive into that a little bit more because I'm always intrigued, obviously what is a good property? What is a good, cash flowing investment? I've heard some people that say, hey, I have to be netting almost 250 outside of taxes and mortgage and on expenses. 250 is what I want to be cash flowing. Some people have a different rule and different regulations. So I'm just curious, what to you, and when you're looking at your team and analyzing a property, what are some things that say, okay, this is really good? And as well as, do you mainly do, another question, do you do mortgage or do you do creative finance? And what does that strategy look like? As well?
Yeah, I mean, we don't do creative financing or anything like that, right? Because we got money. We're just doing our boring agency financing, Fannie Mae, Freddie Mac debt. And, this is real estate investing. If you don't have money to invest, you don't have money at least for the down payment. You can't real estate invest, bro. You got a money problem. And that's where all the house flipping, HGTV stuff, the wholesaling stuff comes into play. We're more working professionals, we have high salaries, we have some money. We're doing this in a very different way, more boring way, a way that maybe 95, 99% of people can't do it, where, hey, we already have the money for the down payments to do this stuff. So what are good rental properties? I bought my first rental properties in Seattle, Washington, and what I realized is sophisticated investors don't really buy at these high price, sexy markets. We call them primary markets like California, Hawaii, New York, Boston, Miami, Seattle, Portland. The reason being is the numbers don't support the investment. We don't have that 1% rent to value ratio out there. Take California. I mean, you'd be lucky to find a place in the ghetto for 400 grand that rents for $2,000 a month, and then 2,000 divided by 400 grand is 0.5%. That's no bueno. That's not going to work. So I later bought properties in Birmingham, Atlanta, and Indianapolis. Traded the Seattle properties, and we primarily look for B class, C class properties. So not your high end luxury stuff, because you're not going to find the rent to value ratios in those areas, and not the super low end, not the war zone class F, class D properties. Kind of in the middle, right? We work with workforce housing. So this is kind of the majority of lower middle class America.
Mm-hmm. That makes perfect sense. Okay, so like one of your rules is like that 1%. Okay, that makes perfect sense. Obviously, B2C is kind of, is that what you said? B2C kind of properties, nothing too crazy, right there in the mid where a lot of people overlook it. And then what other kind of rules do you have that says, okay, you know what, this is very cash flow, kind of a good property in your sense?
Yeah, I mean, we don't go after niches, right? Some people go after like student housing, military towns, or like near like cool tourist attractions. We don't invest off gimmicks. We invest off of like sound financials. And I mean, workforce housing is the huge elephant in the room. Right? It's what's going to be here for a long, long time. I mean, that's what we invest off of.
Yeah.
And then
do you do a lot of like research in regarding that area and the appreciation? And I know like Texas, for example, and I know some places that I lived in Ohio, they're obviously depreciating. They're just the value of the house isn't producing. I'm just curious, like, do you do a lot of research as well? Does that kind of come into play with, hey, is this a good property to invest in? Is this a good area? Or is it mostly just, hey, is it cash flowing? And is the rent at 96% or 97%, renter?
Yeah, I mean, I'm sure we've done the research on it, but this is why we like real estate, because it's not rocket science. It's basically, I mean, it's two things: it's economic growth and population growth that you're looking for. And how do you define economic growth? Well, I don't really know, right? I mean, there's different metrics out there, but if you're looking for like the one stop, it's population growth. And they just released the 2020 census, so one could just Google this stuff super easily. And you're looking for certain cities, certain submarkets, which ones are growing better than others. And I mean, that's what drives demand for real estate, right? It's just pure population, especially for workforce housing. So we kind of look for areas where they're typically going up. And this typically mimics, we also want to stay in landlord friendly states. So, I mean, not to say anything politically, but like when I'm the landlord, I want to be in a red state, with landlord friendly laws. And typically the red states are, better economically driven too. So
Yeah.
that kind of leaves us to, probably the best places to invest just on a state perspective is Arizona, the whole state of Texas, Alabama, Georgia, Florida, the Carolinas. You take those 5-6 states, they're going to beat the other 45, 46 states out of the nation any day.
Yeah, that makes perfect sense. Awesome. Well, and that's a very interesting point, because whenever we look at real estate, I also do the same thing. And whether it be consciously or subconsciously, it just seems like the better deals are out there because you could just work with the legality and things like that as well if you run into a problem. Now, let me ask you, kind of like, do you focus on certain different deals as well, like 4-plex, 6-plex, 8-plex? Are you talking to 100, 200, 300 units kind of properties?
Yeah, I mean, today, we focus on large apartments over 150, 200 units. We found that once we go over 50 to 100 units, we can have a full-time property manager at the property at all times. But really what we like is when we get around 100, 150 units plus, now we can have that the handyman to kind of knock out work orders, plumbing repairs without having to pay ridiculous third-party charges. and then have some guys HVAC trained on staff. And what we do is we'll put together passive investors and buy a large apartment complex. And what we'll do is we'll stay below the large guys, the institutions that are just investing lazy retirement money. They don't need to make a great yield because their investors aren't very sophisticated. So, these guys will want to buy packs of properties, right? Or 500, 600, or 1,000 properties plus. So these guys will typically play in the $100 million range. And where we want to stay is right below them. Like I said, 100 to 400 units is kind of where we like to stay. But we want to stay above the mom and pop investor. And the mom and pop investor buys single family homes, duplex, triplexes, quads, maybe a 40 unit here, there, or maybe an 80 unit sometimes when they get bigger. But, in this kind of lower rung, things are very expensive, very, very expensive. So we want to rise up and get above that. So there's a nice little void for us, again, between the 100 and 300 unit. That's not really practical for people listening, right? And, part of my website is kind of to teach people how to buy their first rental property, because that's quite honestly the hardest part of this whole thing. We've created systems and teams that kind of take care of it a lot easier and a lot more robustly than when I was starting out, just buying rental properties. That's what I would suggest people do.
Definitely. Well, and it's interesting that you bring that point up, because see, a lot of our audience, they have, they make, 12, 14, $20,000 a month, and they do very well. They have a high ticket item. They do coaching, consulting, service provider, whatever it may be. And, or maybe even e-commerce. And so they make a lot of money in cash flow, but I do know real estate has incredible tax advantages. Now, I know you're not a lawyer, right? And so obviously disclosure there. However, though, you are a businessman and you've obviously leveraged real estate to the highest capacity. So I'm just intrigued with some of our audience that has, they're making $100,000, $200,000, $400,000, and they got some cash just sitting in the bank. What have you found is very successful in regarding to, tax advantages for real estate, for those that are not familiar with how to leverage that and kind of hide the money, if you will, in real estate?
Yeah, I mean, like the younger guys under $1 million net worth, I would say go buy some rental properties, learn the business a little bit. Don't do any house flipping for sure. That's for broke guys. But if you're already an accredited investor, I would just skip right to syndication, passive investing in large private placements. A lot of it is just investing with the right people, understanding the deals. What does the deal look like from the outside? What does the black box look from the outside from a passive investor's perspective? This is where I realized around 2015, when I had 11 rental properties, that they're just not scalable, right? Nobody really owns a lot of rental properties who's smart, right? You transition to private placements and syndications. And when I started to join different masterminds and got around other high net worth investors, it was more about getting rid of your rental properties, which are high liability, kind of a pain in the ass. You've got all the debt in your personal name. And especially hard for business owners, right? You're trying to get more debt. You don't want debt bugging you down in rentals. You want to outsource the debt, go in as a passive investor where somebody manages your investment for you and takes the debt out of your name, and you're just an LP passive investor, not a managing member. So that's kind of what my podcasts have kind of been, that journey, right? My own journey from buying some rentals to accredited status and beyond. But one of the big reasons for doing that is the taxes, right? Like when you own little rental properties, you probably write off the property 1/27th of the property value over 27 years, which is cool. But when you're in larger deals that have the scalability to go get what's called a cost segregation, which basically breaks down all the components, it gives the CPA a big stack of papers to aggressively write off your investment a lot faster. I mean, in some of these deals, you're able to write off a third of the building value in the first year. So you're talking like multiple six figures of losses, paper losses your first year, which you call passive activity losses. Now you can use that to offset your passive income from other investments or the real estate that you got. But this is where we'll strategize with clients. Like a lot of the doctors or high paid income earners, you may be able to use those passive losses, my first few years I had maybe $500,000 plus of passive losses suspended, not used yet, to offset my ordinary income. So think of it like a doctor making $1 million a year. We want to drive up down as close to the $300,000-$400,000 mark, because when you go above there, as we're all seeing Biden's going to go chop heads that are higher than 400 grand. Who cares? Just get your head down, right? Use your passive losses to lower your taxes using a strategy called real estate professional status. A lot of hoops to jump through, but there are other things out there too, like land conservation easements. Another way of lowering your adjusted gross income. It's not about paying less taxes. It's about lowering your income, your adjusted gross income, to pay less taxes.
Mm-hmm. That makes perfect sense. And I think that's really interesting that you mentioned that as well, regarding you don't individually, the most successful, the ones that don't individually own every single unit, but they're the ones that obviously are syndication and partnerships and stuff like that. And so if you could tell me a little bit more about kind of your story behind obviously going from, obviously you own 6,000 units, but that's through partnerships and stuff like that. But going from that 2015, owning 11 properties to boom, all of a sudden where you're at now, owning 6,000 units and having that higher exponential kind of mindset.
Yeah, going back, 11 rental properties, 5 in Atlanta, 4 in Birmingham, I think 1 in Indy and 1 in Pennsylvania. It's cool, right? Like, each property gave me a few $100 of cash flow after all expenses, vacancy, CapEx, a few $1,000. I was still working my day job as an engineer, but that was kind of like a third paycheck for a single guy back then. It was good, but just to give people some insight, what's it take to be a landlord in that situation? And even if I have property management, right? Like, I don't do this stuff myself. I don't know how to do an eviction. I don't know how to change a toilet. That's for landlords. I'm an investor. We always say, stop being the landlord, be the investor.
Mm.
But with 11 rentals, maybe I had an eviction every 6 months. And I had maybe some kind of big catastrophe that happened every quarter, like a tree falling on the house or some kind of flood in the basement or something like that. And I quickly realized, on that scale, it's fine, right? But like, most of my clients, they want 10,000 plus of passive income, right? For starters. Mm-hmm. So I would need 30 rental properties. I'm like, shoot, well, you got to multiply that exception rate by 3. So now you're talking about an eviction, every other month, some kind of big issue every other week. It just becomes unscalable. And that was about the time where I kind of found a different tribe. And, as business owners, you do a lot of networking. Your network is your net worth. And I found my tribe within the investing community. And this is where I saw people who had transitioned over from direct ownership, which got them there, right? Like, it got me from 0 to $500,000, $1 million net worth. Mm-hmm. But it wasn't the ship that was going to take me to financial freedom. Financial freedom was going to be still investing in real estate, but the taxes, the legal. Another strategy we'll employ is infinite banking. The strategy that the wealthy do. And I started to realize that all the stuff that I was learning from, just individuals was very simple and easy, but it's very opposite than what my parents taught me, what coworkers were doing, right? Like, I was like, who does this stuff? But I was kind of slowly changing over what I was personally doing, selling my house that I lived in, because this doesn't make any sense to own your own house. Getting rid of my retirement accounts makes no sense to have retirement accounts, in my opinion. I'd rather pay my taxes today and get it out of that stupid system and invest in good investments. Everything was kind of backwards, right? And going back, like, look, I'm not a CPA, I'm not a lawyer, right? But I've gotten myself financially free, and I've helped a lot of clients do it this way too. Sometimes asking those people, probably the wrong people, right? They're still stuck in a job. They haven't figured out this stuff.
Yeah. So let me ask you a little bit more in regarding that story, and I really appreciate you sharing that. But let's take a step back in the 11 units. Okay, so you had 11 units all over. You were doing property management. Did you have to step back a little bit and sell some of those, decrease your net worth, to be able to go and jump into that bigger arena where you obviously were able to do more strategic partnerships and things like that?
Yeah, as a passive investor, a lot of times the minimums are like $50,000, $100,000 to kind of jump on board. I had some cash. I was able to save maybe like 50, 100 grand out of my day job every year. So I had some cash piled up. because I knew, I mean, even up to that point, I kind of knew these rental properties were kind of becoming a pain, and I was searching for the next thing, right? I didn't know if that was a 20, 30, 40 unit, right? That was the logical progression. But when you're like I said, when you're under 100 units, you're getting the worst lending. The banks know you're just mom and pop sophisticated investors.
Mhm.
You're competing with everybody else. I mean, the pricing is horrible. Not until you get above 60, 100 units plus, you kind of the pricing get a little bit better, right? It's no man's land in that arena. And it took me a while to kind of figure that out, by banging my head against the wall, obviously, by looking at deals. Um, so I kind of went down the path of being a passive LP partner. And then, I mean, I just had money. I mean, like, look, if you don't have money, this ain't for you guys, right? Like, go buy a rental property and build up your asset category so you can in turn build up your passive cash flow category.
So you also were sitting on cash just from your job, but did you refinance anything, pull some money out, and then be able to leverage that as well into your bigger deals to be able to obviously elevate to that next level, if you will? And
I sold in 2018. I sold most of the stupid rental properties.
Did you? Okay.
Yeah, and
And
I
what was
had a
your thought
big.
process behind that?
I mean, the return on investment is just way stronger. I mean, when you're buying rental properties, especially when you're not doing value add, right? Like a lot of the kids on TV do. Um, you're just buying like a little rowboat, right? Just slushes in the ocean. I mean, it's still a lot better than what you're getting in mutual fund stocks and all that type of stuff. Returns and that stuff to me are like 20, 30%. When you include the cash flow, mortgage pay down from your tenant, the tax benefits, and then a little bit of appreciation and luck in there too. People don't believe me. They can go to my website. I do like a little whiteboard video on this at simplepassivecashflow.com/returns. But when I figured out the syndication stuff, it's like a cruise ship because it's a bigger asset where you, the investor, don't do anything. You're working with pros who are kind of running your investment for you, and they've got skin in the game. And the concept between the little rowboat without an oar is where it's just slishing, sloshing, doing nothing, going up and down with the market, is that the cruise ship has a motor, and that motor in the syndication is that there's some kind of value add strategy. Most times we'll go in, we'll buy a stabilized assets that means cash flowing day one, but we won't buy it unless there's some ability to bump the rents up. So we'll usually put maybe $4,000 to $6,000 into every unit, which isn't hardly anything, right? From house flipper land. House flipper land, you're talking about housing scopes of $50,000, $200,000 plus. No, not in apartments where we can turn them and burn them. We do it on a huge scale, right? We get great economies of scale. That's $4,000 to $6,000. There's new flooring, new appliances, new paint job, but we won't really get into big stuff like knocking down cabinets and all that like nonsense, right? We're just trying to put a little lipstick on the pig to bump the rents up maybe 10, 20%. But in commercial real estate, if anybody has kind of done any research on this, but if you increase the net operating income, that has a direct impact to the bottom line, and it's magic. Right? You increase the net operating income of a property by $100,000, you effectively created $2 million of value right there out of thin air on a 5 cap.
Gracious. Okay. So you obviously went from the 11 unit, you obviously sold some of that in 2018, then went into more of the syndication. And so tell me a little bit more about, syndication and some of our audience. Obviously you can find some good strategic partnerships, but I mean, how do you find that syndication? How do you find those right companies, those right investors? Is it just networking? Is that really what it comes down to? Or is it, hey, you know what, let's go to a specific, specific mastermind or someone that has that ability like yourself that obviously have that established network?
Yeah, I mean, it's a lot of it is like a pay to play, right? You got to get yourself into the right room. And anybody can do a syndication, right? You just do a stupid podcast and you write a fake book and you write a blog and you can put together a webinar. You just go on Fiverr and like have somebody make a pitch deck for you, do a little webinar and Zoom. I mean, anybody can do it, right? So it's really hard to determine, well, who's been around a while, who's a larger institution.
That's my question really, is how do you find the best of the best, right? Not some little peon that's just trying it out like, oh, I'm 22 years old and I've done the. How do you find the right people that say, hey, when I give you a $400,000 check, hey, I know I'm going to get that return on investment. They've done it, they've produced it, just like yourself. You've obviously been there, done that. So What
Yeah,
would
I
you
mean, it's
recommend?
your network is your net worth, right? Like you only go off of referrals from people that you know, like, and trust, that they've dropped 150 grand with. And like crowdfunding websites, if you're unable to network and play nice with others, crowdfunding websites is a way of going there. But again, the crowdfunding website's paying a middleman, right? They're people going to them. I mean, crowdfunding websites will charge them an arm and a leg. We've looked at them for raising capital for us, but I don't want to pay that
Mhm.
ridiculous commission to them. Whereas we already have a group of investors that kind of trust us and have been in past deals with us. A lot of it is just like you got to know other pure passive accredited investors. And I did never grew up in that type of community, right? None of my friends were
Yeah.
rich, but it's all kind of who you hang out with. Like the local real estate clubs, free online forums are some of the worst places to hang out.
Mhm.
And then on the
So
other end,
really,
right? Like you go to
really
the
what you're
country
saying
club.
is that they should come to simplepassivecashflow.com and talk to you guys. Is that basically what you're
Yeah,
saying,
I mean,
huh?
essentially, yes. But you gotta go look for other high net worth people that also do this type of stuff, right? And
Mhm.
this is what makes it extremely difficult, right? You're trying to find somebody who most passive investors, they want to be very private. They don't
Mhm.
want to get
Mhm.
sued, right? They don't want to wave a flag in the air that I'm rich, come sue me. It's very hard to find, real pure passive investors. To
Mhm.
me,
Mhm.
everybody's got a website. Everybody's got like these marketing schemes. I'm in this business. It's hard to tell when I'm trying to invest my passive investor money, like who's legit, right?
Mhm. Right, right. Yeah, I mean, 100%. And so that's why I really appreciate kind of perspective. And that's my question is like, there's so many people that have a good game that makes it look, look all pretty and stuff like that. Everybody can do that, have fake testimonials or whatever. But the thing is how do you find the right people that actually been there, done that? And like you said, I mean, they're not out there, pushing their name a lot of times. They're people that are just putting their nose to work and just kicking butt. And obviously that's somewhat what you're doing. You're going out there producing those results. So, if some of our audience, you guys are listening, you guys have that extra 300, 400, even 150 G's sitting, I would recommend reaching out to Lane here, and he'll probably be able to, hook you
Yeah.
up. Now, my question is coming back to the deal that allowed you to get to that higher level. What kind of deal were you looking at that you were able to? And was that yourself that just came in, or did you have some partners that came in and help you with that? Because obviously, in 2015, you sold all those 11 units, and you took some of that cash flow with the other cash flow that you had. And did you get into one or two, 40, 60, 100, 150 units, or what did that look like? What did that deal look like?
Yeah, I mean, in the beginning, I mean, it took us a long time to get established. The hardest thing is investors. You just get such garbage from brokers in the beginning, right? Because they think you're just another like couple of rich dudes from Apple or something out in California, right? An out of state buyer. So you just get thrown a lot of junk your way, and it usually takes a couple years for people to kind of break through that if they're lucky. So we've in the beginning we bought a lot of like Class C properties that were like 50 units type of range. We did the business plan to them. We sold them because they're kind of a pain in the butt to manage. We've kind of been swimming upstream, getting more Class B assets
How
in better
so? How so?
areas.
Was it because of the tenant structure, or is it just because just the area, or like what caused the
Um,
pain?
it's a tenants, right? Because when you're
Mhm.
kind of in that realm, I mean, for people who have never owned Class C rental properties, I mean, it was a culture shock to me. I mean, you're talking about like 50, $100,000 type of properties right out in the Midwest and South. If you guys have ever been out there, I mean, I
Mhm.
most of my clients and myself, like we're Californians, West Coast people, Hawaii, right? We're used to houses costing 500 grand, so that's a shack, right? Most people in this country are living in $100,000 properties as rentals, um, and a lot of people in the Class C realm, they may or may not have bank accounts, right? Like when I had my rental properties,
Right.
I remember the ones I had in Birmingham. I mean, a couple of them were like Section 8. Like
Oh, wow.
most of them paid via like Walmart money orders. I was like, what the heck, right? Like I didn't know Walmart you could get money orders at. Apparently, it's a great place to get money orders because it's cheaper
Right.
there. I
Well,
mean,
I appreciate you saying that, because what I always found very interesting is, you could look at the numbers and say, okay, the numbers really work very well. I mean, we were just looking at a 50 unit over here, where I live, and it just looks beautiful. It's awesome. But then when you get to the location, you just start realizing pretty quickly the caliber as well, and the headaches and the things like that. So even though the property may look good, it's those other extra headaches and those things that are intangibles that you don't see sometimes on the budget sheet. So I'm curious as well. So you went from there, you bought the 50, 60 units. Then you obviously sold those, and now you're getting into, you identified your niche, if you will, 100 to 400 units and things like that. And what was that next deal that allowed you to get into that higher end and started, working with B and really B product, B properties?
dude, I don't remember. I mean, there's just we have like over 30 something deals. I think it was just, I mean, if I recall, we were doing like these 50 to 80 unit properties for about a year. And then I
Oh,
think
wow.
maybe the first one might have been like 120 or 150. And then at that point, that's where, that was maybe like the dozen deal mark in. And that's where we really started to get, brokers, the biggest thing for brokers control deals, especially stabilized assets. Like, remember, we're not going after garbage properties that are less than 90% occupied. So brokers control these assets. You're not going to send a yellow letter to some apartment owner. Hey, can I buy your property for 50 cents a month? No, they're not idiots, right? They're not like
Yeah.
little run like single family home owners that don't know how to read. That which I believe wholesaling is. I don't feel like it's very like ethical in my opinion. But I'll get off of that. Right. Like in our world, apartment owners are pretty sophisticated. They go to brokers to fetch the right price. But 99% of deals will pass on because just the pricing doesn't work. We're looking for that situation where the owner is a little bit distressed. They're either old, they're dying, they're retiring. There's something in there. They want to re-diversify their portfolio or consolidate elsewhere. Um, but the property is fine, right? The property is
Yeah.
great. We're distressed owner, not distressed asset. So in these cases, brokers control assets. So it's important for us to have a good track record of being good guys to work with, not retrading, closing when we say we are. And at that point, once we had closed several properties and we're in the market talking and actually talking to these brokers in terms of, hey, you're the guys with that 50 unit out there. You want to sell your property? Like, well, no, we just bought it recently. We're still doing the business plan, but what else you got to buy, right? Like,
Yeah.
because it's a quid pro quo thing. I mean, it's all commission based. Let me make friends with these guys so we can eventually sell their property, make the commission on that, and let me give them the deals to buy. A lot of and that's the hardest thing is to break into this business doing that stuff, and then we eventually kind of stepped up to swam upstream to those larger assets. Today we're doing even a little bit of development too because we
Yeah.
try and get away from like where the majority of like the amateurs are kind of hanging out.
Yeah, yeah, definitely. Cream of the crop, if you will. And so tell me a little bit, kind of, because obviously getting up to that higher level, okay, you're not going, I would imagine you're not going to loopnet.com and realtor.com and, finding those
No,
big
I mean
deals.
LoopNet
You're,
is we laugh because it's like the where deals go to die. That's when it's been out there for a few months. You just wanna find garbage deals to laugh at. But then again, you find the newer, hungrier brokers, and
yeah.
sometimes they can find good deals, but most times it goes to the guys with teams under them, like the
Mhm.
established brokers.
So now, though, tell me, like, obviously, majority of your deals obviously just come from the network that you've built. Correct? I mean, just from people you've talked to. Hey, you know what? This guy's 80 years old. He's looking to sell his 150 unit. Okay, hey, let's take a look at it. And have that conversation before it even jumps on the website and so forth. Right? That's basically kind of, it's just through warm referrals. Is that kind of, is that what I'm hearing
Well, that's the
you say,
broker's
bud?
job. In commercial real estate, the brokers actually do their job. I don't know what the hell they do in residential real estate, but the brokers are the ones taking flowers to grandma,
Right. Well,
calling
I'm
these
asking.
guys again and again. They're the ones
Yeah.
that control the deal. So we need to get in good graces with the brokers so that they feed us those said
So
deals.
correct, because sometimes the brokers don't even put them on the website. It's that they just have them, and so you just already have those relationships with the brokers. That's basically what the situation
That's
is?
correct. Like an off
Okay.
market type of or
Yeah.
preemptive offer. I mean, their biggest concern is this deal going to close? They don't care if whether it sells
Correct.
for 45 million instead of 30 or 51
hmm
million. makes no difference to them. What they want is assurance to close. So that when they know, like, we've closed deals in the past, we're easy to work with, they want us in there, and as opposed to the other guy. And even the buyers, right? The buyers want assurance to close, right? They want to see your balance sheet. They want to see your sponsor roster. They want to see the track record. Are these guys just a bunch of jokers from California? Or are these guys in the market already buying? Have they proven to close already? Especially the bank financing. Have these guys, are they approved with the bank? Where are they going to get their capital source?
Yeah, definitely. Awesome, man. Well, let's just jump back because I really appreciate you sharing that because I mean, again, the biggest thing that I want to really, kind of foot stomp in that, what you just said is just building a network, right? Or working with someone that's already been there, done that, like yourself, Lane. That's like, okay, well, shoot, instead of having me do all the crap for the, 2, 4, 5, 10 years, whatever it took you to accomplish what you've been able to establish, be able to leverage someone else's credibility like yourself that's already doing it. Now, my question though is during that time, okay, obviously it's not just roses and petals down the little golden road, right? It's ups and downs. So I'm curious, was there a point, Lane, where you thought you were going to go belly up, or was there a point where you're like, okay, this is just not going to work, there's something's going to fall through, or in any time during that situation, or was it just a golden road going to the golden goose?
You're not gonna like this, but I mean, shit. We invest off cash flow. We don't invest off appreciation. We don't gamble. We go into assets that are stabilized. Like, it's kind of smooth sailing for the most part. I mean, the only thing is, like, a couple times I've worked with a bad partner, and that just sucks. I've had to kind of, I mean, that's just, you lose your money. I mean, that's how this business works. It's the times where you're going to lose money is when you work with unethical people and you just don't work with them again. And this is why it's so much more important to build your network. I mean, I'm kind of at the forefront. I'm kind of working with different people all the time. Lately, I've been kind of working with the same proven people in the past, but that's kind of why I do what I do. I'm kind of the forerunner. I'm kind of out there, taking chances so that other people can kind of, ride along on this once the concept has been proven, right? And that's it's going to happen. But if you're a passive investor, you kind of just ride alongside people who've already made the mistakes already, and jump in on version 2.0, version 3.0 in a way. But yeah, I mean, that's happened to me in the past, and it's very frustrating. And I what I do is, like, every time I've made that mistake, I can always contribute back to, like, I did not work with somebody who I was able to really verify their track record, meaning I didn't have this gold level standard of referral. I didn't have somebody that I already knew and trusted say, yeah, man, I've worked with this guy in the past. I vouched for him, right? It's always been kind of a loosey-goosey type of scenario. First time, I just got like a random referral off of some, like, self-directed IRA custodian that didn't know what the hell they were doing. They didn't even invest with it. And he said, oh yeah, we'll work with this guy. That was back in like 2011-ish. I didn't know anything back then. And then the next time, like, somebody who did a bunch of real estate, but maybe not in the realm that we're working in, right? And I didn't have anybody like that third party referral, right? That's the gold standard. But when you start out, you're not going to have that. I mean, like I said, you got to play the long game. You got to build pure passive investors. Build friendships and organic relations with that, because these are the people who put skin in the game to figure out who's legit out there. And you've got to build this web. That's why we created the mastermind group in this community. And, like you say, well, go talk. I like to talk to people, but I tell people on our onboarding calls all day, it's like, look, man, whatever I'm a syndicator. Whatever I say, take it with a grain of salt. In fact, don't even listen to what I'm saying. Don't trust me, but go and verify everything I'm saying. I'm just telling you what you want to hear. I'm kind of the salesman here. In fact, but what you want to do is go hang out at our community events, right? Go talk to the other passive investors, right? Surely I can't, like, pay them all off, right? Well, I do. We pay them returns, right? Every quarter.
Yeah.
That's the way you're supposed to do it. And it's a little bit more of a headache, but if you don't want to put any effort in, well, go invest in the stock market and mutual funds and all that type of nonsense.
Well, that's awesome, and I really appreciate you sharing that because I think that's very interesting what you just mentioned. Because see, you don't hear that in the mainstream, right? It's very unorthodox of what you just mentioned, because you're just being straightforward and straight honest and saying, hey, you know what, this is kind of what this is the situation. So, my question as well is like, obviously, you've been doing this for quite a few years. So what does that future look like? I mean, are you looking to get 6,000 units? Obviously, where you're at now, are you looking for doubling that in the next few years? Are you going to kind of sit on your hands until you obviously say, hey, you know what, there's some better deals in the near future? I'm just curious, what does that look like?
Yeah, I don't know. I mean, I think from an operation standpoint, business standpoint, I'm just going to keep picking up rental properties, apartments that cash flow day one, and with a little bit of value add, and keep rolling on that business plan. That I think it's the best risk adjusted uh, kind of business out there. I mean, if there's a
Mhm.
recession, well, the A class luxury stuff moves to our stuff, and we stop rehabs and we just cash flow. I mean, it's a beautiful thing. Um, I mean, as terms of like what else other than just keep doing what we're doing. I mean, I feel like my thing in this world is kind of to help people get educated and at least reverse the brainwashing that we've, like myself and a lot of people have, gotten from our parents, coworkers,
Mhm.
family. Um, that's why we have like I still kind of the podcast, the website, a lot of it is like geared towards people buying rental properties, getting started. A lot of it's for free. People want to get the free remote investor e-course, they can text the word remote to 314-665-1767. I mean, it's just all just to get started, right? Get out of that Main Street, that Wall
Mhm.
Street kind of dogma investments.
Definitely, definitely. Because see, what I found very interesting is Lane, even though you said it wasn't this massive ups and downs and turmoil while you're building your business, to me it seems like you just focused on the things that produce results, and you've said, okay, well, be disciplined, right? You're not going to go after that $10 million unit or whatever because the numbers just don't work, but you're going to go after the $3 million unit because, hey, the numbers work, right? Whatever it may be. And just being disciplined with it. I found that very interesting. What you're just saying is, if you focus on your rules, your whatever you have to say, hey, this is producing these 1%. Obviously, looking at the 100 to 400 unit, I just think that's very interesting because what I found in success in life in general is like, hey, you got to make sure you have certain regulations that allow you to say, okay, these are my boundaries, and if this is a good opportunity, then fantastic. If it aligns with it, but if it doesn't align with any one of those, I'm passing by on the deal and the opportunity. And it's tough, but obviously I would imagine there's probably hundreds of deals that probably come through your door, but you don't accept, or you don't get all excited by each one, do you? So I'm
It's
telling.
kind of the analogy is kind of like, what your pitch is in baseball, right? There's some might be strikes, but you just don't swing at it. You know which one you can like jack to left field, you pull that one. In terms of like what it looks like for us, I mean, like secondary, tertiary markets in growing population submarkets, that cash flow day one with a little bit of value add. I mean, like people always ask, like, well, aren't you afraid of a crash or recession? It's like, well, not really. I mean, the people who got hurt in 2008, which was by way of a real estate correction, right? Most recessions aren't don't really get impact too much in real estate. 2008 was the anomaly, and that's why it was so big. But the people who got hurt in that scenario were the people investing for appreciation, right? Was it the big short strippers, the taxi cab drivers who those assets did not cash flow, right? And that's why I tell everybody, like, hey, what we do is very different, right? We're cash flow guys. I mean, people can go download my free analyzer and go look through your expenses, your maintenance, repairs, capex, right? You start to learn the numbers and you start to realize, well, even in bad times, all right, let's play around with the numbers. Let's drop the rents 50, $100. Let's keep the expenses. Like maybe we get hit on this expense, that expense. And you see how really robust even one single family home rental. Um, so I implore people, yeah, go download my free analyzer, simplepassivecashflow.com/analyzer, and play with around the numbers yourself, right? Like this is a different game. We're not house flippers here, right? That's for broke guys who need to go gamble and roll their money, right? We already have money, right? We have good paying day jobs or successful businesses, but we just need a place to store it, to grow it a little bit incrementally, prudently with cash flow, um, and get the tax benefits too.
Yeah, that's awesome. That's awesome. Well, thanks so much, Lane. I really appreciate your time and obviously being able to, talk to our audience that are a little bit intellectual in these conversations. Obviously, not just talk about beginner and how to start and, be motivated, just take action. It's diving into, okay, a little bit more details on this and obviously the benefits of it and being able to actually tell your story as well. So I really appreciate your time, Lane. Thanks so much. Now, let me ask you, where can, obviously they can reach out to you, simplepassivecashflow.com. And then I would imagine probably your name anywhere on social media. Explain a little bit about our audience, how they can reach out to you, Elaine.
Yeah, I mean, they can probably Google Simple Passive Cash Flow. The website pops right up. The URL is simplepassivecashflow.com. A lot of free stuff for accredited investors and people just getting started with rental properties. If you're in credit card debt and these types of people, we're not the tribe for you. I mean, I'm very against these these gurus that like teach people all this nonsense about wholesaling and flipping, and then they charge them all this money. They don't have money to begin with. I mean, that's why everything's kind of free on the website and the podcast,
Awesome.
Passive Cashflow.
That's awesome. Well, thanks so much, man. Again, I really appreciate your time. And again, my audience, that link is actually down here in the description below. You can take a look at that. But other than that, Lane, thanks so much again.
Yeah. Thanks, Christian. See you, everybody. Bye.